Hi, and thanks for joining us for our November issue of the Carbon Real Estate Group newsletter. As you can see, we're trying a new format this time around. We're starting to forge ahead with video, and we're excited to be producing some new video assets that we will be seeing in the future. For now, enjoy this month's report, all in this video.
The media currently loves to embellish our real estate market as being similar to Chicken Little's Storybook Classic. But trust me when I say, the sky is not falling, and I'll show you how. Comparing 2016 to 2017, it's like comparing a Formula One sports car to a Porsche. You can't. Other than 2016, the last 5 years have performed amazingly. 2016 was a record-breaking year with most amount of properties ever sold in October, lowest average of days on market for a unit in October, and the lowest amount of listings active for October, with the least amount of listings available for fiscal year, and lastly, the most amount of properties in a single year. Now for 2017, listen folks, a Porsche is still a Porsche. This year we've seen total active listings are up for October. Days on market are back up to a normal level. Total units sold are down for October. And number of listings have skyrocketed, with number of sales being down. This is really easy to explain. When there's a lot of choice, people take their time to look at all the properties that are in their price range before they make a decision. We call this a flight to quality. That said, we are still seeing a resurgence in multiple offers and offer dates on quality listings. Listen, the fundamentals of Toronto real estate market remain the same as always. We have low interest rates, we have a strong economy, we have low unemployment, we have an attractive Canadian dollar for foreign investments, we have high net population growth, and a great multicultural, diverse city. To conclude, it is still a good time to buy or invest in Toronto real estate.
We received several questions regarding the new stress test to take effect January 1st and thought we'd go over it to make sure you make an educated decision when buying. Basically, this new stress test impacts any conventional mortgage, meaning buyers that are putting at least 20% down payment. Those buyers, effective January 1st, will have to qualify at the highest of either the 5-year benchmark rate or the posted rate plus 2%. It impacts any purchase done after January 1st, meaning if you've purchased December 27th and closed February 12th, you are fine. This also applies to any of you refinancing. If you're staying with the same financial institution, that institution might exempt you. However, they have the authority to run you by this stress test as well if they elect to do so. What's important for you to know is that credit unions that are under provincial legislation are exempt by this new stress test. We might therefore see some of them auto-regulate and decide to follow those rules nonetheless, while others might try to get a bigger share of the market by offering more aggressive rates. Overall, your purchase power will be reduced by 20%, which is non-negligible. To give you an example, if you currently make $100,000, you will be pre-approved as of today for $556,000. Starting January 1st, that amount will go down to $451,750. This is over $104,000 less, meaning people will be going for a completely different product altogether and definitely smaller homes. What there is to take for you here is to be mindful who you go to for your mortgage needs. If you don't have anybody, please give us a call. We'll be more than happy to refer you to a team of specialists, experienced people. Thank you very much.
So what does this mean for our future outlook in real estate in Toronto? Given that interest rate increases are being delayed later into 2018, we're going to see less downward pressure on prices from interest rates. We do have new mortgage rules, which are going to remain to be seen as to how they're going to affect the marketplace. The belief is that it's not going to make a big change, It will downgrade some buyers to a smaller price category or a different category of home. We still see strong demand in the condo market. The rental market is flying through the roof this past summer, and it's going to start making a purchase versus renting scenario push renters toward buying. So that could see a lot of momentum in the condo market headed into 2018. For house prices, right now we're seeing a decreased spread in looking at the home price index or housing price index between all the four categories: detached, semi-detached, attached homes, and condominiums. What we're seeing now is a tightening of the gap between a detached home and a condominium, which enables condominium owners to make that transition to a larger home more easily than they had in the past. As with Vancouver, the impact of the foreign buyers tax introduced last April will likely see no effect going forward. After about 6 months in Vancouver, we started to see prices increase. We're now hitting that tail point of price correction, and we're going to start to see likely a single-digit upswing in prices across all four housing categories. We hope you enjoyed this month's new video e-newsletter format. We'd love to hear what you think about it. Give us a call, send us a message on Facebook, or shoot us an email. We're always happy to hear from you. Thanks for watching, and don't forget to follow us on social media.